I was in discussion with one of our clients, a 35-year-old software engineer working on the SaaS development on in one of the leading breweries in India. She had recently started her investment journey with us after 2022. She had only seen the rise of the markets, seen her portfolio perform beautifully, and then one fine day in September 2024, she was hit by the market correction. When I was discussing about her portfolio a month back, I could sense her anguish. I could sense her anger. I could sense her resentment. She was angry at the markets. She was angry at her portfolio. She was angry with us. And she asked me a question that I still remember till date. She asked me, "You are financial experts. Did you not know that the market is going to correct? Get me invested in these funds. If you knew that the market is going to correct, you should have asked me to stay away from the markets completely." I understood that this was not just the doubt and the resentment of that investor, but it reflected the sentiments of each and every investor that we have today with us. Each one of you must be questioning the position of the markets. What is happening to the markets? Why are the markets going down? When are they likely to recover? So that conversation laid the foundation to today's market outlook. Here we will discuss one, why are markets corrected? Two, let's talk a little about when are they expected to recover? Three, let's talk about converting this crisis to opportunity. Can we do that? Yes, we can do that. And we have done in the past, and we will continue to do that in the future. And fourth, and finally, those of you who feel that markets could correct a little further, yes, they can definitely correct a little further. But those of you feel that we should wait for the markets to correct more and then we will invest, or those of you who feel let Sensex touch 80,000, let Nifty touch 25,000, let budget come, let the Fed cut its rate one more time, let the Monetary Policy Committee do one rate cut, then we will start investing. My final part of the discussion is going to be for those of you. So stay with me till the end of the discussion. Let's get started. If I have to sum up all of the slides in one single picture, it is this picture. Sensex had started in 1990, and the path to wealth creation was never linear. It was filled with ups and downs. We saw a big correction in 2008 due to the Lehman Brothers crisis over here. We saw a big correction in 2020, global pandemic crisis. We saw a big correction in 21, which was the Ukraine-Russia war. We also saw the upside of the rally, this being one of the biggest rally from 23 to 24, when all of the macroeconomics of India were looking beautiful. India was growing at the fastest possible rate of 8.2%. We saw another big upside right before the Lehman Brothers crash in 2007. We saw another upside in 21 after the global pandemic crisis. So the market has shown both the sides, upsides as well as downsides. But the end result is always bright, sunny, and uplifting. It is positive. End result being, if there is one consensus that you and I can both draw from this picture, is that if you invest in the markets and if you're invested long enough, you're going to make money out of it. You can take any 3 years out of this graph and you will realize that if you invested at the beginning of those 3 years, at the end of 3 years, you will always be at an upside. So investments in the market, whether you are at an upside or you are at a downside, if you stay long enough, and when I'm saying long enough, I mean 3 to 5 years, you will be rewarded for your patience. Last year, 2024, was one of the most picturesque years that we saw. India performed the best, one of the best performing markets globally, not just emerging markets, but also in terms of the global leaders. India delivered 18.5% return right up to September 2024. And even after the correction that we saw till December, India had still delivered an 8% CAGR in the year 2024. All of the macroeconomics, whether it was the GDP growth rate, whether it was the inflation, whether it was the current account deficit, were in control. And then September 2024 hit, and it almost looked like we are in a crisis-like situation. What happened in 2024, 24 year and 25? Nifty 50, Nifty mid cap, Nifty small cap, all have corrected from their peak positions, and we are looking at a correction between 11 to 13%. But why has this happened? This has largely happened because FIIs are pulling out of the market. In this month itself, we have seen FIIs pulling out more than 50,000 crores from Indian markets. However, I am sharing this with a caveat that this is not just happening from the Indian markets. This has nothing to do with our macros. This FII pullout is happening across emerging markets. This is happening from Mexico. This is happening from Vietnam. This is happening from Brazil. So India is not an exception in terms of FII outflows. Why is this FII outflow happening? This is because the US bond yields have risen to a 4.6%. Now, US bond yields means risk-free money coming from US markets. So if I am an institutional investor, if I am an FII, and if I see that my home country is giving me risk-free returns of 4.6%, why will I invest in an emerging market and take the risk in the emerging market? I might as well go in the home market. And this is one of the highest that the bond yields have been. This is why all of this exodus is happening across the world. This bond yields are also being aided, rather, the exodus of FIIs from our home country is also being aided by the slowdown in corporate earnings. Q1, that is April, May, June, we did not see any kind of government capex happening because of elections. Q2, we saw a major crunch in the consumption. There was no consumption happening. We expected the consumption to pick up after the festive season. It did pick up slightly, but it hasn't picked up as such. However, Q3 in terms of the consumption definitely looks better than the Q2 numbers. So we are on the path to recovery. Then the slowdown in GDP growth has happened. GDP growth from an 8.4% per annum has been downsized to about 5.4%. And dollar has strengthened largely because we imported a lot of gold in the last year due to the festive season. However, our exports were not as much, so there was a balance of payment imbalance. When our imports were outsizing our exports, we saw strengthening of dollar against the INR. All of these factors combined led to the correction in the markets that we are seeing today. However, this is not the end of the story. There is definitely a silver lining at the behind the cloud. So, as I mentioned, Indian macroeconomics are absolutely looking fine. There is no problem with respect to the macroeconomics. When I'm saying macroeconomics, I'm referring to our fiscal deficit, I'm referring to current account deficit, I'm referring to our inflation. These figures are still under control. It is only that the lacksidal corporate earnings have led to a reduced GDP growth. However, the betterment of the corporate earnings, the betterment of the consumption is once again likely to result in an improvement in terms of GDP growth. FII outflows are happening all across the markets. India is not an exception to it. Rural consumption was very flat in the past 3 years. However, when you look at the results of two-wheeler automotive manufacturing company, fertilizer companies, or companies which are manufacturing tractors, companies which are largely benefiting from rural consumption are actually showing better numbers. So this is one pocket in the entire zone where we can see an improvement in terms of consumption. Government capex, which was not happening in Q1, Q2, is finally starting to happen. This is when you look around you, you can see this government capex actually happening around the ground, on the ground. Adani Airport in Navi Mumbai is nearing completion. The first test flight has already happened. The Zevar Airport is nearing completion and is likely, the first commercial flight is likely to happen in April 2025. Delhi University has launched 2 more campuses. The rapid railway transit system from Delhi to Meerut has been completed, resulting in downsizing of the travel time from 4 hours to about 2 hours. So a lot of government capex is finally happening, and this has to happen before the budget, because if the government is not going to spend the quota that they were allotted in February 2024, all of that budgetary allocation is going to lapse, and that is why government has to do a lot of capex leading up to February 2000. And finally, banking sector, which was an underperformer in the past 3 years, is finally out of the woods. So last year we talked about defense outperforming. We talked about realty outperforming, we talked about capital goods outperforming, we talked about infrastructure outperforming. Banking sector was an underperformer, but when you are looking at the results of banking companies, when you look at the underlying problems, such as the deposits, such as the credit quality, all of those problems are being converted into opportunities for the banking sector. We'll talk more about the opportunities which are present in the banking sector in our opportunity slide. Stay with me. So, all of these problems that have happened can be either viewed as a crisis, they can also be viewed as an opportunity. Let me show how can you view all of this as an opportunity. Nifty is currently at the level of 23,000. September 2024, it was at a peak level of 26,000. There has been a correction of 12%. Now, in the past, whenever there were steep corrections, all of those corrections resulted into quick recoveries, which means that it is important for you to capitalize on these levels. Let's look at the correction in 2020. 2020, the global pandemic crisis was one of the steepest corrections that we saw in equity markets. Markets had corrected by about 38%. The price to earnings of Nifty had also corrected by about 40%. But within the next 8 months, Nifty was back to its original position, and the return that one got from the lower position just to recovery was 20%, which means that if somebody had invested on the lower position of 7,600 and went back to the original level of 12,000 from where markets were correcting, they were rewarded by a return of 20%. June 2022, when Ukraine had been invaded by Russia, markets had corrected by 17%. They corrected from 18,000 level to 15,000 level, but within a span of 5 months, they were back to normal. So somebody who had managed to capture the correction level of 15,000, only while breaking even, only while reaching the original level of 18,000, they got a return of 21%. Now also, you are getting a similar opportunity that you got in 2020 and that you got in 2022. Nifty has corrected from a level of 26,000 to 23,000. That's an 11% correction. A similar correction is also there in the price to earnings or the valuation of Nifty. It is only a question of investing at this point of time. If we invest at this point of time at a level of 23,000 Nifty, even if we reach back to 26,000, and this will happen sooner or later, Nifty will once again bounce to the original level of 26,000 from where it corrected. You are likely to make an upside of 13%. Not a bad upside, I would say. If I'm just talking about recovery to the original level, and Nifty is not going to stop at its original level of 26,000. It is going to go up to 28,000. It is going to go up to 30,000. So the upside is not just 13% from here. The upside is 13% plus from over here. Can we capitalize on these opportunities? Yes, we can. We have capitalized on these opportunities in the past. We are going to capitalize on these opportunities in the future as well. Let me show how one of our clients had benefited from this opportunity in 2022. This is one of our clients' portfolio that we constructed in 2022. Person is 55 years of age, working at a general manager position in one of the leading PSUs in India. He had never really had a great experience in the equity markets. However, when we explained to him the logic that markets are highly corrected today, if you are investing in this level, the bare minimum return that you can make from this level, once markets recover back to their original position, is at least 12%. And that was better than the returns that he had himself generated in equity earlier. That was better than the returns that FD has given to him. And he was okay. He understood the logic and he was okay with those kind of returns as well. So we constructed the portfolio in 2022. We constructed a broad portfolio comprising of hybrid mutual funds, large cap mutual funds, mid cap mutual funds, some degree of small cap to cause wealth creation as well. And the result of this portfolio is in front of you. I'm just going to zoom this portfolio. The person had invested 40 lakh rupees through SIPs through lump sum starting April 22. The portfolio's result is worth 62 lakh rupees. And this is a conservative portfolio. This is not even a 100% equity portfolio. spite of the market correction that we are seeing today, in spite of that 12% market correction, his portfolio has given a 19, almost a 20% CAGR. Not a bad CAGR, I would say, for a person who is conservative in nature and whose portfolio is currently seeing the brunt of the correction. So, yes, this is clearly an opportunity for all of us to capitalize these levels. However, the entire length and breadth of the market is not an opportunity. There are clearly overvalued sectors, there are clearly undervalued sectors. Let's identify where are the undervalued sectors. Let's identify where are you required to invest to capitalize on these opportunities. The first and the most clear opportunity that is present in front of us is large caps. Sensex and Nifty both have corrected about 11-12% from its peak levels. It is not just the correction from the peak level, but when you look at the price to earnings of large cap, when you look at the price to earnings of Sensex as well as Nifty, that is also undervalued. So Sensex and Nifty were looking slightly overvalued at about 23 just a couple of months back. Today, we are below even the 10 years average, which was 22. So today, the large caps, that is Sensex and Nifty price to earnings is looking at about 21. That is below the 10 years as well. And that is why I'm saying that this is a highly undervalued space, which you should make a large part of your portfolios today. Opportunity number 2, which is present, is the banking and financial services. Why banking and financial services? Number one, banking and financial services has been a laggard in the past 3 years. They have not performed. If we look at the returns which have been delivered by Nifty 50, past 1 year has delivered a 9.26% CAGR. Nifty Bank, representative of the banking companies, has resulted in a CAGR of about 7.94%. So Nifty Bank has not even been able to outperform Nifty. Secondly, we are looking at very good credit growth, which is happening. So till last year, the credit growth, which is the lending side of the banking sector, from where it actually makes its net interest margins, where it actually makes its returns, that side was not there in 2024. However, in 2025, we are looking at a much improved credit quality happening in the banking sector. And because of the concerns shown by RBI, this credit quality is also much more improved in nature. As a result, we are seeing a highly improved asset quality. If you look at the gross NPA ratio of the banking system, it has lowered down from 9.1% to an all-time low of 2.7% in 2023 to 24. Hence, banking sector is one such area which has extremely clean balance sheets, is available at an attractive valuation, and is also likely to benefit from the sectoral rotation. Why I'm mentioning sectoral rotation? In the last couple of years, the sectors that performed were defense, capital goods, infra. This one sector that did not perform was the banking sector. So people who have benefited from growth in defense as well as capital goods, they are likely to cause an outflow. They're likely to cause profit booking from those overvalued sectors, and they are likely to enter into this undervalued sector. And hence, this shift in the funds is what is going to cause the recovery of the banking sector in terms of their share prices. The third opportunity, which is present across us today, is multi-asset funds. Multi-asset funds means we are giving you the benefit of equity for wealth creation. We are giving you the benefit of debt, which is fixed income in nature, which is going to give you a fixed return year on year. And thirdly, we are also giving you the benefit of gold. Now, if equity markets are performing, this fund is going to perform its best. It has a high composition of equity in it. But if equity markets do not perform, where does money go? Money tends to go into gold because it acts as a safe haven. Money tends to go into fixed income products such as corporate deposits, government bonds. If equity will not perform, debt and gold are there to take care of your portfolio. So in all kinds of weathers, in all kinds of market situations, the fund is going to protect the portfolio. They're going to give you a cushion against the downsizing of equity, if at all it is there. How do you capitalize on these opportunities? One question that may be there in your mind is, do I do SIPs? Do I do lump sum? Do I shift my position? So I'm going to answer all of those questions for you over here. Nifty, Sensex, mid cap, small cap, everything is corrected by 12 to 13%. It is a good idea to add lump sums at this. If you do not have lump sum, a lot of you may be salaried investors who are not maintaining a lot of lump sum positions in their bank accounts. For those of you, it can also be a good idea to switch from either hybrid mutual funds or fixed deposits that you're holding, or debt mutual funds or recurring deposit, anything which was on the fixed income side. It would be a very good idea to convert this fixed income sides into pure equity. How do we do that? We do that by switches in your portfolio. So if you have pure debt mutual funds or hybrid mutual funds in your portfolio, switch them into pure equity mutual funds. And I'll show how that switch can be done or how that switch has been impactful in the next slide. The third thing that you can do is, if you are having incremental cash flows due to a salaried income, you can also do an SIP top up. If your SIP is a 50,000 rupees, you can easily consider topping it up by 10%, 20%, whatever the availability is. Lower market conditions are the times when you should do an SIP top up, or when you should do an lump sum to make your portfolio even more impactful. So let me show how we have done one of these switches for one of our clients in the past, and how we have been able to turn around the portfolio. This was a portfolio constructed for one of our investors in 2020. In 2022, the Russia-Ukraine crisis had happened, and market had quickly corrected by 15%. You can see that the Sensex level is at 52,842. This portfolio is dated 7th of March 2022. See that in this portfolio, we have maintained a hybrid mutual fund called ICICI Prudential Asset Allocator Fund. This is highly conservative in nature. We have maintained this specifically for market correction. This fund holds 60% in gold as well as in fixed income instruments.
I'm sorry to interrupt, ma'am. Can we zoom it a bit? I think it's not very visible. Yes. Yes.
So we have maintained 20% portfolio in this hybrid mutual funds, and this was specifically maintained for such market corrections. You can see that this is right at the time of the peak market correction. The portfolio is suffering the brunt, and it has a return of 8.6%. 11th of March 2022, we were able to capture the Sensex level of 55,000, and we did a switch from this hybrid mutual fund to a pure equity mutual fund. Let me show you the impact of that switch. So the switch was done on 11th of March 2022. We switched from hybrid mutual funds to pure equity mutual funds. The switch is visible over here. You can see that on 11th of March 2022, a new entry has been created, which is ICICI Prudential Small Cap Mutual Funds. We have been able to capture Sensex level of 55,000. Okay. Yes. This portfolio is now dated 18th of March 2022. Yes, the Sensex level is visible over here. Yes, this 55,000 level is visible over here. We have this portfolio is now dated 18th of March, when Sensex was at 57,000, and you can see that purely from the switch. This switch has resulted in a 3% absolute return improvement in the portfolio. After a week's time, specifically 11 days, the markets recovered. You can see that after a period of 11 days, with the market recovery and with the switch, the portfolio has finally resulted into a performance of 19%. So there was a drastic portfolio improvement performance from to about 19%, which was due to two factors. One was the market recovery, which eventually had to happen, and the second was the switch. So make sure you leverage these positions. For all of our investors, we create these hybrid positions. Make sure that you utilize these switches. Make sure that you utilize these hybrid positions to impact your portfolio. Finally, on to another very critical part of this presentation, Why not to time the markets? Market timing has been proved to be costly. One, no advisor in the world, no investor in the world is able to time markets accurately. It's an impossible job to do so. Nobody over here can predict what Nirmala Sitaraman is going to talk about in her budget, whether markets are going to go up from here or they're going to go down from here in the next 1 week. What is resulted in portfolio returns is being invested in the market. And let me show you how. So those people who have tried to time the market have left some good days out of the market. It is not possible for humans to predict the markets absolutely accurately. And when people try to do that, they end up missing some good days out of the market. Now, on the face of it, it looks okay that some days have been missed out. But when you actually convert them into results or returns, you see the drastic difference. You see the drastic losses that you would have made. So this graph pertains to a person who invested 1 lakh rupees in 2002, March 2002, and invested till 2022. The person who stayed invested in the market, irrespective of the market conditions, converted that 1 lakh to 23 lakh rupees. The person who missed out just the 10 best days lost about 7 lakh rupees. The result was only 16 lakh rupees. The person who missed 20 best days resulted in 11 lakh rupees, and the person who missed 40 best days resulted in 3 lakh rupees. So this is the power of this is the power of being invested in the market. This is the loss of trying to time the market. The differential is not too small. The differential is very, very significant. The differential of trying to time the market is 20 lakh rupees in a period of 20 days. So don't be the kind of investor who tries to time the market and says that I would want to markets correct further. It may not be possible for you to do so, and it may prove to be very costly for you. This brings us to the end of this presentation. We discussed there are 3 C's to make money. One, you require cash. Cash means liquid positions. These could be in the form of fixed deposits. These could be in the form of debt mutual funds or hybrid mutual funds. Making money in markets requires a crisis. You are in a crisis-like situation today, and making money requires courage to exit those safe investments and courage to invest in the market, provided you are investing for the long term. Utilize these 3 parts, these 3 areas which are very much available to you today, and that is what is going to result in creating wealth for you. Second, Sensex has corrected about 11% from the peak. It is a good opportunity for us to invest. Where are the opportunity areas today? The opportunity areas are in large caps. The opportunity areas are in banking and financial sector. And there are opportunity areas in multi-asset funds. How do we leverage on these opportunities? We can do so via lump sum. We can do so via SIP top-up. And we can do so via converting our hybrid positions to equity positions. And finally, do not try to time the market. It is better to stay invested for the long term. Markets are going to reward you for that. This brings us to the end of the presentation, and we are now open to any questions that you may have. Please feel free to write your questions in the chat box, and we'll attempt to answer them.
Thank you so much for the presentation, Shalini. I think we have a couple of questions. So Mr. Nishit Panda has just mentioned that what happens if it will take 1 to 2 years to bounce back, and then the move of, I think, switching is not good?
So, your conjecture may be entirely true. It may entirely be possible for markets to recover post 1 to 2 years. However, if you make these switches in the next 1 to 2 years, you are still entering in the markets at a lower level. Even if the markets rebound from today's level of 23,000 to the level of 26,000, you are still looking at an upside of 12%. That is better than the upside that you are likely to see in a fixed deposit, in a bank account. That is likely better than the performance that would be displayed by any other asset class. So equity markets in the long term have proved to be better than any other asset classes. I'm not talking about asset classes such as crypto and practical asset classes, including equity, debt, as well as gold. Equity has known to outperform all of these asset classes in the long term. So even if markets are going to take 2 years to bounce back to the normal, you are still better off by investing in these equity levels as compared to placing yourself in safe havens like uh, debt. These moves are practical only if you are investing for the long term. I'm talking about long term investing. I'm not referring to short term investing over here.
All right. Anybody else? We have any query from either of you? You could raise a hand. You could type in into the chat box. I think everybody's doubts are pretty much cleared. Nobody has any to ask.
Right. I would also want to mention one more thing that we have created these hybrid positions into the portfolios of all of the investors that are currently working with us. Uh, in case somebody has not, although we have approached all of our investors to utilize these equity levels in order to create their switches, in order to convert their switches from hybrid to equity, in case somebody feels that they have been left out, they are uh, most welcome to reach out to us. Please reach out to us, to your relationship manager, and please do let us know, and we will create these switches for you.
Okay, we have another question from Mr. Rajiv Verma. If we assume market will bounce back after 2 years, then why we correct our positions or invest now?
See, Mr. Rajiv Verma, we don't know when the markets are going to recover, right? For sure. What we know is that in a matter of 3 years, markets are definitely going to look up as compared to today's levels. So, and hence, investing at this level definitely gives us a very strong case. Markets may improve by budget 2025. Markets may improve further whenever we see interest rates being cut in our economy. This is likely to happen in the JFM quarter, which has resulted due to the growth concerns that that we have seen. RBI is seeing the growth concerns, and in order to improve the growth of the economy, rates are likely to be cut. Rates are also likely to be cut because US has also already done a rate cut. US has already done multiple rate cuts. So India is one economy which tends to follow US economy in terms of either the rate hikes or the rate cuts. So markets may recover in the next 7 days, they may recover in the next 1 month, or they may recover in the next 2 years. It is not definitely possible to say so when they will recover. However, it is clear fundamental that if you are investing at a lower level and markets are going to recover up from here, it makes for a strong case to invest today rather than investing when markets are recovering. If you invest today at a 23,000 level, that is always better for you. Markets, and if and when markets recover to 26,000, rather than you investing at 26,000 level and then waiting for a market recovery from there.
All right. Any other questions? Anybody has any doubts? Please feel free to raise your hands and then you can unmute yourself and you can talk here.
Ma'am, if you can also touch upon the stock strategy, since many clients have questions regarding that. So, what is the overall strategy that we follow, and like in which markets and what kind of a market does it perform the best, and in which like there is a kind of a flattish curve in the performance?
Sure. So a lot of our investors today are stock investors as well. In our stock strategy, we are investing on the basis of three fundamental factors. The first one is financial strength of the balance sheet of the company. The second one is the valuation, and the third one is the momentum. So at any point of time, we will be taking stocks which are high momentum in nature. Unfortunately, in the past 6 odd months, rather 4 odd months from September till now, we have not really been in a situation where there is high momentum. There is a low momentum on in all of the stocks, and that is the reason that the stocks in the past 1 or 2 months, our stock strategy has also not delivered the highest possible results. This is because stocks themselves do not have a high momentum at this moment. However, the moment this situation reverses, and the situation can reverse once the bond yields start strengthening, the situation will reverse once we have a rate cut situation either in US or in India. This situation will reverse once the INR starts strengthening against the dollar as well. So, all of these three factors are likely to result in the reversal of the momentum situation that we have today. The moment we see some momentum coming out of the stocks, our stock strategy is designed to pick up high momentum stocks from the overall universe. The moment you see that happening, you will automatically see performance coming in our stock portfolios as well.
Shalini, can I add on a little bit over there?
Yes, please do, Abhishek.
Okay. So on the stock strategy as well, Tanmay, thanks for putting that question. If we look at this stock strategy, and if you look at mainly Gatishil, that is our primary basket. Uh, this basket has a tendency to overperform in a bullish market, and in a bearish market, it kind of tries itself to adjust itself according to the index correction. So if we look at uh, the pros and the cons with the highs and the lows from April onwards till about, let's say, November, we had a good alpha as compared to a Nifty 50. This alpha would be ranging from 25 to 30% over and above the Nifty 50 returns, right? So if Nifty 50 gave about 12% till about September and October, the stock strategy, which is Gatisheil, gave about assuming around approximately 35 to 40% on an absolute basis, and all the investors would have seen that in their portfolio. Now, when the markets have corrected after that, the correction is very similar to the index. So, all the indices, including small cap, large cap, and mid cap, and even Nifty 100, have corrected by almost about 13% on an average, plus minus 1% on an index level. So, between 12 to 13%, and the stock strategy has also corrected by a similar level. So in a bullish market, it gives the alpha over and above the Nifty 50, and in a bearish market, it kind of restricts its downside a little bit. If you look at the downside, it's very close to the index. So that's what we kind of try to do in the stock strategy. Yes, what Shalini mentioned, the stocks that we pick up are basis three broader parameters, which is financial strength, valuation, and momentum. But at the same time, we try to also understand that in a downside, how can we restrict our negatives, right? So it doesn't go beyond the index, or it stays closer to the index. So that's what has happened in the stock strategy. In the in the bull market, it overperformed the index quite significantly, and in a bear or in a lower market in a correction phase, it's keeping its losses around the index level itself, right? So whenever an upside happens, again the same strategy will be followed. So when an upside happens, when the indices bounce back from here, again the alpha would be added, because in the downside we restricted our downside towards the index itself. And also it's also very variable in terms of the caps that we pick, right? So we can have a large small cap exposure. Even then, our downside is restricted. And at the same time, if the markets demand and if we don't get any good stocks on the small cap side, it automatically shifts towards large caps, on its own. Given the valuation is a filter, so if we find that valuation is good towards the large cap side, it automatically turns towards the large cap. So it's very dynamic in nature as far as the market caps are concerned. Yeah, Shani, that's about it from my end. Over to you.
And Mr. Rajiv Verma had asked me a question: if even if markets are expected to recover in the next 2 years, why invest today? One more point that I wanted to add to my last discussion was that if I give you an option of one shop which is giving you a set of stocks, good quality stocks to you at a 12% discount, and I am giving the same set of stocks to you in a shop B, when the same set of good quality stocks are available to you at a 12% premium, where would you prefer to buy them? If the quality of the stocks is good in both of the shops, it is obviously more practical to buy them when they are available at a discount. So that is the situation today. You are getting good quality stocks in the market at a 12% discount. It makes more sense to buy these set of stocks at a 12% discount rather than buying at a premium. So if market recovers in the next 2 years, the same set of stocks that you could have bought today at a discount will be available to you at a premium, from which the upside will then be limited. From a lower level of Nifty, the upside is much higher. Once markets have already improved, and if you start investing at this level, the upside will be limited at that point of time. Hence, it makes more sense to invest today rather than waiting for the markets to correct.
All right, I think we have. Do we have any other questions from anybody else in the audience? I think we can have the closing remarks.
Yes. So thank you very much, investors, for joining us today on a Saturday afternoon. I wish all of you an excellent weekend ahead and an excellent investment journey together with you, working on financial wealth creation for all of you. This is Shalini Gera. I will be seeing you on more such financially relevant topics very soon. Till then, take care of yourself. Bye-bye.